All right. Hey, it's Drake Griggs with Obsidian Wisdom. Welcome to another Retirement Readiness Thursday. Today, I have an interesting case study for you. There was a question that I had received, and the question was, will my retirement savings last for 30 years? And so today, we'll go through one of those examples, and then I will show you how you can figure out how it's looking for you, right? How you just quickly be able to just summarize, all right, am I on track? Am I not on track? How am I looking? And then I'll give you a few examples that you'll also be able to use, as well as some strategies and some things to think about. So what we'll do is we'll start with the whiteboard. We'll go through just some of the high level numbers. Then I'll end it with the case study, and you'll be able to take a look at that, and then you can decide, how am I looking? Am I on track? So let me go ahead and share that with you. Move that to the stage. Okay, perfect. Okay. So when it comes to us understanding whether or not our retirement savings will last, that is a question that we all have. That, interesting enough, there are numbers that show that there are people who have more than enough money and are uncomfortable spending it in retirement. That what we're going through is, I've been saving. I've been saving for a pretty long time. I'm used to not spending. I'm responsible with my money, so I don't know if I should or even if I want to spend it. And then there are others that don't have enough, and there's just a very small few that understand how much they have, know how much they can spend, and they feel very comfortable spending it. Those would be the people that naturally have a plan and they have the numbers to look at it. If for no other reason, I think the benefit of having a plan is you always know where you're at. Whether or not the plan is going exactly as you decided, you at least have a feeling. You know if you're on track, how much you could spend, and we've been able to test it, stress test it, and I'll show you what some of those numbers will look like. So first, let's start with just a quick example. So for many people, when we talk about the idea of how much can I spend in retirement, the average person, what they're thinking is probably the 4% rule. And I'm sure that you probably are familiar with that. So what we'll do is we'll say I have $1 million, and then what I will do is my withdrawal strategy will be pretty straightforward. I'm just going to take out 4% every year. So that means the first year you would take out $40,000, and that is what your 4% is. The thought of the 4% rule is, most likely you have an investment strategy that is going to generate at least 4% every year, right? That's the idea. So as a result, hypothetically, if I am able to take out 4% and my account is invested in a way that is generating at least 4%, then that means that I'm never really touching my principal. That I should always have $1 million inside of my account. That my account grew by 4%, I took out 4%, I should still have the same amount next year. There's a couple things that people enjoy about that. Number one is it gives them a little bit of certainty where they know how much they can take out and they're not worried about running out of money. And the reason that we're not worried about running out of money, and the reason a lot of people do like to maintain the principal, not that we all actually need to, but the issue is, let's say your account only generated 2%. So you took out 4%, but your account generated 2%. What you would end up then seeing is next year, and well, actually, let's just make the math a little bit easier for me. Right. So instead of us doing that, let's say that the account next year just had 900,000 in there. Well, if you were to follow that same, and let me see if I can get my calculator out. If you were to follow that same 4% rule, when you have $900,000, then what you would be taking out now is $36,000. If the account went down to $800,000, use my calculator, then as you can see, we would have $32,000 in the account. What you're basically saying is the 4% rule, if my account is actually losing value, then how much I can take out decreases. What ends up sometimes being what is almost feels like a death spiral is, if I take out more than my account generates, then each year I have a little bit less money that I can spend if I just maintain the 4%. Naturally, the issue is we're not keeping up with inflation. We haven't even calculated inflation, which realistically, let me remove some of these. Realistically, if we'll assume that everything is above board and we're looking good and everything's moving very nicely, what we would do next year is we would just take a look at what inflation is. And let's say that inflation is going to be, I don't know, let's just say inflation is 3%. So then what I would do the second year is I would take that 4% and then I would multiply it by the 3%, which would give me 0.12. So the next year I would take out 4.12. And then if I looked at that, and then the next year I would end up taking out, right? So if I did the 4.12 times 0.03, so another 3%, then I would continue going up by that. But let's first start doing our first year. So if I go by that amount, now I have my $1,000,000. That means that the very next year I would take out 41,200. And then that would have me keeping up with inflation. So then the question becomes, all right, Dre, if that's what I'm going to do, right? I'm going to take out the 4%, but it increases every year with inflation. And I'm still generating a 4% return. Doesn't that mean that I'm going to be eating into my principal sum? And the answer is yes, that we would. So what do we do to build comfort? And that comes down to what your withdrawal strategy is. Because the question that is being asked is, how do I make sure my money lasts for 30 years? And you know that the way inflation works, the rule of, what is that? I think the rule of 72 is that it's about every 20 years, a 3% increase in inflation means that it's doubled. That so if I had $20,000 that I was generating and I needed that amount to come in, that in 20 years for me to have the exact same lifestyle, I would need $40,000. So in this particular case study, if we have $40,000 that we're taking out each year, the assumption is that in 20 years, I would need $80,000 to afford my same lifestyle. And we can think through a variety of things where the cost of things have gone up over 20 years. So right now we're in 2025. So in 2005, what was the price of gas? Right? What was the price of gas? I'm going to go ahead and I'm going to place that in. I'm going to place that in the search engine. So let's see what the price of gas was in 2025. Price of gas, or 2005. Sorry. It says in 2005, gas was $2.30. And right now, what is the average price of gas right now? And it says right now, the average price of gas is $3.20. So we can see that the price of gas has gone up about $1. So about 50, about 45% increase in the price of gas over the life of your retirement. We're not going to do eggs because we all already know the price of eggs has has gone up a bunch. The price of eggs in 2005 was about $1 and maybe like 10 cents, $1.20 for a dozen eggs, and it's currently closer to $10. So that's kind of the outlier. We're not going to talk a lot about eggs, but we get the idea that the price of things goes up. If I maintain my same money, then I'm going to be in a tough spot. So we have to make sure that our investments are always at least keeping up with inflation. And I will show you a couple of investment portfolios and what these are called. These are called model portfolios. So let me share this screen with you. All a model portfolio is when we're investing or you're building your investment portfolio, all we are saying is on a average return over the historically speaking, that these asset classes generate a certain return. And then based off of these averages, we can then create a portfolio that takes your risk into consideration, your timeline, which we call a time horizon. Don't ask me who named it, why they named it that. And then we can also just take in the return that we need for our retirement. And depending on how we feel about these markets, we can put an investment strategy together for you. I do think it's important to note because I know a lot of people are very uncomfortable with the stock market. I talk to people all the time, and like, look, man, the market went up last week, and then it went down this week, and then went up the week after that. And for me, I'm big on having strategies that works the majority of the time, right? I do not pretend to give you a guaranteed return every single year, but I do try to position you in a way that allows us to have a long-term successful strategy. And so one of the things I like to share with people is there was a study that was done, and it said that 90% of the stock market is owned by the top 10% of wealth in the United States, which is crazy. If you just take a step back and think about it, 90% of the stock market is owned by the top 10% of wealth in the United States. If I just did the top 1%, They own about 50% of the stock market. The top 1% owns half the stock market. And then naturally you would say, all right, Dre, if the top 10% owns 90, about 90% of the stock market, I think it's 89%. Then how much does the bottom 50% of Americans own? And the bottom 50% own less than 1% of the stock market. So for me, we understand a couple things. One is I agree. I don't like the feeling of losing my money. Who would enjoy that? But at the same time, if we don't keep up with inflation, we've already accepted that we lost our money. That if you went in time travel and you could go back into 1900 and fill a safe up with $1 million, and then you come back to 2025, you and I would agree that that's not the same $1 million. That you would need about $12 million to have the same purchasing power of someone in like 1910. Now, at the same time, though, if I went back in time and I filled up a safe with gold, just bars of gold. So I visited Fort Knox. They said, hey, what's up, Dre? Welcome in. And I filled up a safe with bars of gold. And then I went back to 2025, and then the bars of gold are in there. I think we would agree that the bars of gold have increased in value significantly. Now, am I telling you to invest in gold? No, I'm not telling you to invest in gold. But I am telling you that we should invest in assets that do appreciate over time and can outperform inflation. Because if I went back in time and I gave you some investments in the stock market in the 1900s to the stock market right now, again, you would have a significantly higher return on your investment. You would have a lot more long term. The stock market, considering the recessions and because coming off the gold standard and the oil prices and Y2K, 9/11, the Great Recession, all these events, if you put the money in, or you put the stocks in the safe, took it out in 2025, you would have significantly more money. The only one of those scenarios that you would guarantee lose your money over a 100-year span would be if you invested in nothing. With that being our reality, because the government does print a bunch of money and because inflation is what inflation is, we have to invest in things that maintains our purchasing power, because we don't want to be 30 years in retirement where we put our numbers in a calculator and it said, hey, you're good to go, but we can't purchase anything because the price of everything has gone up over time. So hopefully that makes sense for you. So let's go ahead and let's make the adjustment now and see how we can invest the money in a way that helps us to be comfortable. Now, first of all, what you'll notice is, yes, that I would say for the majority of people, if you have $1 million sitting in an account, and what I'll do is I will show you where they have it at. And so you can see in this particular situation, they had $1 million that's sitting inside of their 401k, and then they started recently contributing to their Roth. Because Mark and Lisa are both in their 50s, they get what we call the catch-up provision. All that is the government says that once you're over 50, you can give an additional $1,000 to your IRA and your Roth IRA. You can give an additional 1,000. So instead of it being 7,000, it could be 8,000. You also have the ability to give an extra $7,000 and some change to your 401k. So it's 23,500. You can go up to 30,000, right? So the government is giving you this opportunity to increase how much money that you have for your retirement. Now, in this particular situation, the money is there and the investments and the strategies will be fine. They actually were a little bit more aggressive than they needed to be. And I don't want to say should be, because should is such a strong word, but they were a little bit more aggressive than typically someone who is that I would say that has achieved the $1 million, right? Because at some point the thought should be, I want to get rich, I want to get rich once, right? So I hit $1 million. What can I do to make sure that I'm not putting too much at risk? And then I'm able to leverage that money, because the goal is to get rich once. And then we make some good financial decisions. So what I do and what I like to do, and I'll show you, is not even that we need to change it to a conservative allocation. It's just to show them that you don't have to swing for the fences once we hit whatever that number is. That depending on your lifestyle, how much you're spending and things like that, we can adjust your allocation in a way that preserves your win. I'm not saying we need to go full prevent defense, like football, because the only thing they say a prevent defense prevents is the win. That if you go to prevent, allow the quarterback to run up and down the field, things happen, crazy things happen. But at the same time, it would be weird if you stopped running the ball. If you just knew you like the clock was on your side, you're in the fourth quarter, you're up in the lead, it would be weird to just throw 3 times, 3 and outs, give the ball back to the other team. You should mix in some runs to end the game. Sorry for the football analogy if you don't watch football, right? Sorry, but I had to use it. That's the way that we're adjusting this, just to show them, hey, we can make some conservative adjustments lock in some of your wins, and then we still actually achieve the goal. And let me show you why we're able to achieve the goal. So you can see what we had here is they actually were going to generate on average about $12 million. And that was based on the allocations that they had. I wanted to show them what the allocations would look like with a more aggressive approach, and then we were able to maximize the taxes. Now, what ends up happening a lot of the time, and it happened for them as well, we end up putting all of our money inside of our 401k, and they had that very similar situation as well. When we have all of our money inside of our 401k, it ends up being taxed as ordinary income in retirement, which plays a role into whether our $1 million will last for 30 years once we retire. If all the money is going to be taxed, what sometimes ends up happening, and I may be able to show you one of those charts, what ends up happening if we don't make any adjustments whatsoever, you can see that these are the tax brackets, and it shows you the amount of income just projected that someone would need to move into a new tax bracket. What we end up doing sometimes is we actually are going to move ourselves in a higher tax bracket. And then let me show you on the whiteboard why that would end up happening. So let me scroll down. So there's a couple things that ends up happening. We basically have, as I tell you all the time, 65% of self-made millionaires have 3 streams of income. What we end up seeing is you have your one stream that's turned on, and that's your Social Security, and it can't be turned off. So whenever you turn on Social Security, that's it. That money is coming for the rest of your life. You have these things called RMDs. If you leave your money inside of your 401k, because that is a pre-tax account, Uncle Sam is waiting to tax that money. It went in pre-tax, so it wasn't taxed. You deducted that income. It didn't even count as your income on the year it went in. It then grows tax deferred. You don't pay taxes every year that your money grows in your 401k, but then it comes out taxed as ordinary income. So Uncle Sam at some point is tired of waiting. So what does he do? He says, I give you required minimum distributions, very literally named, at 73 years of age if you're retiring, right? If you're still working and then the job qualifies, then you can wait till you retire in some instances. But we're just saying at 73 is a required minimum distribution starts. There's a number, you divide the number by how much money you have in a pre-tax account, and that tells you how much you have to take out. That doesn't turn off either. So if you are someone who has Social Security starting, and then you have your RMD starting, you can't turn either of these off. If you have anything else that you really have a difficulty turning off, so if you had a rental property, if you had a pension, then what ends up happening is you're basically from 60 to 70. Let's say you retired at 65. Well, you notice is your income, I'm working, dips down when I retire, and then I'm living off a little bit, and then Social Security starts, and then my required minimum distributions start, and then that goes with my rental income. Next thing I know, I put myself in a much higher tax bracket with 3 streams of income that I can't turn off. And the pension will be the same thing. Where if you were able to, and that's why we end up doing this, if you're able to perform what we call Roth conversions, which is normally the first thing that I end up looking at. Normally, if I see all your money is sitting inside of your pre-tax account, in my mind, I'm thinking, okay, this is like a tax bomb. We have to put some plan together, depending on how much time we have, to lower this tax bill so that you don't end up having to take out literally hundreds of thousands of dollars that you would not spend. You have no desire to spend. But Uncle Sam is requiring you because it's sitting in an account that requires required minimum distributions. So in my mind, what we'll normally do, let me change the color. I'm going to try to change the color. Maybe I won't change it. All right. So, all right, I'm probably going to give up. Oh, there we go. I was able to figure it out. I was like, man, I'm about to give up on the color. Okay. I just wanted a new color. And so we got one. What we would do is we would say, hey, look, when you're about to retire, at 63, or at least your income starts decreasing, and sometime before 73, what if we filled that lower income up, right? That's the idea of a Roth conversion. Is it's like, hey, you've always been paying taxes at this amount. Why not just keep maintaining your taxes at that same amount? And they'll say, okay, well, what does that look like? I'm like, glad you asked. So let's say you have $1 million inside of your pre-tax account. What if we wanted to lower that, and we're able to lower that to 500,000? So we were able to take out at 63, we took out 100K, right? 64, you took out 100K. At 65, we took out 100K, and so on and so forth. Right? So you get that. Now, this money, when you do a Roth conversion, what you do is you pay the taxes each year. So you pay some taxes this year, you pay some taxes this year, you pay some taxes this year, and so on and so forth. As a result, now you're sitting there, instead of at 73 with this huge tax bill, you have split this up over the years before you retire. Right. So that's the idea of an RMD. And ideally, that keeps you from moving into a higher tax bracket where we're able to manage the tax bracket. Now, obviously, the number, it can vary. It depends on where you're at, how close you are to the next bracket. But this is the idea of required minimum distributions. Instead of me having low taxes on these years, if I just maintain my normal taxes, or even if I get a smaller discount, so maybe my taxes are normally, maybe they're normally in the 30s, and I'm able to have my taxes in the 20s. And I just do these required minimum distributions along the way. If we're able to move some of this money, or maybe even all of it, if it's possible, naturally a lot of factors go into that decision. But if I'm able to move the money, then when you're looking at this chart, you're not accidentally pushing yourself. And then that's what this is. So in this particular situation, because we had $1 million that was sitting inside, let me zoom in a little bit. Because we had $1 million sitting inside of our pre-tax account, knowing it's going to be taxed as ordinary income, you can see that as they retired, their taxes were really low. So the green is us filling in with Roth conversion, so that way they maintain that yellow bar, the same taxes that they always have. And so what we did is we took the withdrawal sequences, your taxable accounts first, and your tax-deferred account second, and your tax-free accounts third. Ideally, your tax-free money is left over, because when you're in the end of your retirement, you just don't want to pay taxes on the income. And that's when you want your money to be able to allocate towards healthcare expenses and things like that. And so by limiting and lowering your taxes, we increase the likelihood of you having the money that you need for 30 years of retirement. And so what we did is we did the Roth conversions at 22%. So that's what you're looking at here. And so anytime their taxes would have been below that 22 to 25% bracket, we performed a Roth conversion so that they just pay taxes at the 22%. We did that each year. And what does that ultimately end up doing? I'm glad you asked. It ends up generating an additional $4 million in assets for them. So what you've seen, and right, we still had about 7 million versus the 11 million, but what we did is we did not have to be as aggressively invested in the market, because market volatility is a real thing. And if you are able to have, the studies show, the less volatile your investments are, the more likely you are to keep your money invested, right? Go figure. I don't think anyone's surprised by that. Well, if I'm able to put a plan in place that limits some of the volatility to where I can take relatively safer investments, I didn't leave the market altogether. My money's not sitting in a mattress. I'm still keeping up with inflation, but I'm not trying to hit home runs anymore. We generate additional $4 million, not having to invest in something else, just by lowering how much Uncle Sam took from me, which I think is what all of our jobs are as Americans. Because at the end of the day, the tax system is incentive-based, which is a very fancy way of saying Uncle Sam lowers your taxes if you give him something that he wants. And when you talk about businesses and how much taxes businesses can write off, is because they give people jobs, and those people pay income taxes, which is about 25% of the revenue Uncle Sam gets. And then they give lots of tax incentives for real estate property. Again, Uncle Sam wants people to have houses, not living under a bridge. So if people have houses, then Uncle Sam said, great, I'm going to give you lower taxes for rental income because you're providing housing for my citizens. So you can see that with an incentive-based tax system, you have the ability to do things that helps the society as a whole, at least from Uncle Sam's perspective. And then it also puts more money in your pocket. The reason that you end up with more money, and I believe I can show it to you, the reason they end up with more money and you pay less in taxes is because you withdrew less money. You did not have to withdraw 3.5 million. That 3.5 million was a result of you having tax deferred required minimum distributions, not because you needed that money to come out to maintain your lifestyle to achieve the goals that you had. It was because you were required by law to take this money out. And when you have to take this extra money out, even if you literally had nothing to do with it, you're like, well, dang, I don't want it to be penalized. Or Uncle Sam, I believe it's at 25%. So in your mind, you're like, all right, well, I have to take the money out. I don't want to be taxed. I don't want to take it out. But what else can I do? This is what else you can do. You can set the flexibility plan up ahead of time to where you're able to do those Roth conversions in those low tax years. And that's what we're able to do for them. And then that helps us on the other end because there's always three. Give me a sec. Because you always have three choices when it comes to what you do with your money. And we talk about that all the time, right? You can either, let me go back to my board, change my color back. All right, you always have the same three choices. We can either, all right, make more money. That's choice number one. Choice number two, we can spend less money. And choice number three, we can retire later. Those are always the same three choices that we end up having. So then if the question, when we say, hey, is $1 million enough for 30 years? Well, it depends. It depends on what the costs are. But if someone is having, and I believe on average, I think Social Security on average, last time I looked, it was like $1,800 a month. So that's what it is on average. So we're just going to stick with the average. So that is $22,000 a year. So that's 22K a year. If you have $1 million and we're just taking out the 4% rule, so we'll just say income, that would be 40K a year. So that would put you at 62K right there before we do anything else. And for most Americans, the average, I believe the average that they say that the median income is like $57,000. That's the median income. So you're already right around the median, slightly above it. It naturally depends on what state you live in, how much you're going to travel, and things like that. Where we add in your unique lifestyle, then we're able to make the adjustments. But as you can see, is it possible? Of course, it's very possible. It's very doable. If we're able to maximize your taxes, if we're able to maximize even some of the investments, even if you said, you know what, Dre, I don't believe in that. Like, I want to pay all my taxes and I don't want to have to do any of this stuff. I'm just uncomfortable. If you just add another year to your retirement, let me show you what that would just look like for the lever number three. And hopefully this is making sense for you. All right, so let me just show you what lever number three will look like. So what you see is we're sitting here proposed plan 7.3 million, right? So that's what we have. Let's go ahead and let's have us retire 1 year later. Right? So everybody's going to retire 1 year later. Nothing else has changed. Same tax strategy. Everything else is the same. You can see that just retiring 1 year later ended up generating an additional $500,000 for them based on the investments that they have. And it ends up, and you're like, whoa, that's a lot in 1 year. How is that happening? Let me give you an example to sort of show you what's happening at the end of your retirement, which is a really cool thing. So I'm going to use Berkshire Hathaway stock. That's Warren Buffett. Let me show what I'm going to do is I'm going to switch this so you can see that in 1 day, how much it costs and things like that. I'm going to switch this to the max. And what you're looking at is what the beauty of compounding interest is. And so what ends up happening, and I can do this with Tesla, Amazon, Apple. I literally could do this with every single stock. You're working along, investing, 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 investing. Nothing's really happening. It's like the money I put in is going up by whatever 5 to 10% every year, 20%. Like Warren Buffett's been crushing it for a long time. But you can see you're just like, man, it's not doing nothing. It's not doing nothing. And then at some point, when the money starts compounding, you see exponential growth starting to happen at the end. Where Berkshire Hathaway, with one extra year, is able to generate a significantly higher return than it did in the other years. And so that's what we're talking about. So this is what the last year is. It's $416 and it went up to $534. That is a 28% increase, which is outpacing the stock market. If you look at it from a 5-year perspective, you can see that it was $197 and then it went up to $534. So that is a 197% increase in the last 5 years. So, Dre, what are you saying? Glad you asked. What I am saying is you may have just put an additional $10,000 in your investments, but because you're at the point of exponential growth, it's compounding where your money is literally working for you, where every time you invest more money, the money grows by leaps and bounds more because of all the years that you built this portfolio and your consistent, disciplined approach. Just one more year could add 500,000, could add $1 million to your retirement account. And it ends up helping you in a couple of ways. So first and foremost, we already said, hey, I got more money in my account. Check. But you also have the extra benefit of not having to withdraw the money out. I didn't have to spend any of the money. That also gives you the benefit of going one more year without touching Social Security. Gives you one more year to possibly do a Roth conversion. When you go one extra year, it helps with a lot of different things. Obviously, your healthcare expenses. If you still have your health insurance from your employer, again, you have another benefit. And so once you start getting to the very end of your retirement, your investments will grow just like this. And like I said, I could do this with a ton of different stocks. So let's look at, right, because Tesla's in the news. So even though they've gone down a bunch, you can still see same deal. Company starting, basically a penny stock to be at like $1. Nothing's happening. Nothing's happening. You see 2020 start increasing. They start seeing the exponential increase. Now, yes, significant losses this year. That is outside of the normal cycle. But what you are seeing is the same idea that the money's invested, and at some point it ignites. I can't tell you what that magic time is when compounding interest starts exploding. But what we can see is this stock still is up 21,000% over when it started. And so you can see that ends up happening. Now we'll do like one more. So let's do like Apple, because Apple's been around for a while. It's another $1 trillion company. They're crushing it as the idea. And look at that. Apple's been around a pretty long time, right? Pretty flat. Nothing's going on. Could you imagine if you bought Apple for 36 cents a share in the 90s? Could you imagine that? Like seriously, just for a split second? 2005, still 99 cents a share. Crazy. You're like, no, that's impossible, Dre. Apple could not have been that price that recently. Yes, it could. 20 years ago, Apple, $1.56. And then you can see something started happening. Obviously, you and I know what happened. They came out with the iPhone and the iPad and the iPod. And then all of a sudden, growth, exponential growth. So you can see that extra year of you working, it feels like, come on, Dre, what is one more year going to do? If you've been investing and you start seeing your portfolio going up and you start hitting that compounding interest in those last few years, every extra year of working is going to be a pretty exponential opportunity as far as growth and the return for you, right? Okay. So let's go. Let's finish up this case study. Hopefully this is making sense for you. Let me check real quick. Did you have any questions as of this moment? Is this making sense? Hopefully this is making sense. Okay, let me check it real quick. All right. It looks like we're good. Looks like we're good. All right. So we'll keep going. Okay, so as far as the $1 million route, we're 50 right now. We got $1 million in our account. This is the growth of us maintaining the proposed plan, which is like relatively conservative, taking our foot off the gas a little bit, but adding the strategic planning of Roth conversions and working on maybe even possibly working an extra year, right? However it looks. You can see the net worth. We have the $1 million in invested. We have 350 in the real estate. The mortgage is only 150, 1.2 million is our net worth. Current allocation is about 60-40. That's between both of them. And let me actually, I didn't share that tab. So you had no idea what I was seeing, but I caught myself. So you will see it now. So I'll go back a second. So you can see that we have the $1 million at 51. That's where we're at. And then you can see that we've allowed the money to grow and it's going to continue growing. When we're talking about your probability, right, what we're basically saying is, let me zoom in a little bit because I know it was mentioned. I try to do that. You can see what we're saying is the median number is $8 million, but there is a 5% chance that you could have 2.9 million or you can have 18 million, right? So either way, you'll have money. That's the good news. Then 50% confidence, right? There's a chance of you having 5 million to 11 million. So if the choices aren't the best versus if everything is amazing, and then we have the median is about 8 million. So that's how we come up with that number. You can see that the current allocation between all of their investment accounts is about a 60-40. And that worked for their risk tolerance. So it wasn't a concern from that. It was just us recognizing, hey, if we're achieving the goals, if we're hitting the mark, if we are able to maintain the lifestyle that you're looking for, do we need to continue swinging for home runs, right? Because if you watch baseball, you know that most home run hitters also have the most strikeouts versus your base hit hitters. They don't strike out as much because they're not swinging full power. So they're at least going to make contact with the ball more often. And so that, right, growing up playing baseball, that's what I was thinking. I feel like if you don't watch sports, my sports analogies are probably annoying, but I love the idea of sports. I love winning and mindset. So I do listen to a lot of professional athletes talk about that edge. And so I do enjoy that a lot. So you can see what we ended up having is we're like, hey, wait a minute, red flag. You have $40,000 in a tax-free account. You got $1 million in a tax-deferred account. I am well aware that means we have ordinary income coming our way in retirement. So there's a couple things that you could do. And it depends where you're at and how close you are to retirement. In this particular situation, right, you can't touch it before 59 and a half without a penalty. So most of the time, I don't say to really worry about that as far as what we do. What I would say going forward, and what I often tell people is, hey, going forward, how about we don't put any more money in the 401k minus the match? Because, hey, you can't leave the match. Free money is free money. If I want to get 100% return on my investment, we got to do the match. But from that forward, we need to invest the rest in a taxable brokerage account. That's your after-tax income. Take it in, put it in the brokerage account. Now we can start building a tax-diversified investment plan. And then you're going to find yourself with a lot more opportunities where you don't have to worry as much in the future. And so that's what we were also able to do. So let me show you what that will look like quick. Let me go back to the whiteboard. All right, so normally when we talk about being tax diversified, there's normally 3 ways your money is looked at by Uncle Sam. Then we'll be all done. So you have your pre-tax. That's the money that goes in before it's been taxed. It does not count as income. I think it's, 403B. You have like a 457. Some annuities are like this. And so all of this is pre-tax. So how is it treated when you retire? Ordinary income. So it's going to be taxed at whatever your normal tax rate is, which goes up to 37%. Right, so that is going to be the least efficient taxes. That if I list off the taxes of everything, the highest is going to be 37%, which is your ordinary income. Least efficient. All right, so then if that's where my money is at, tax ordinary income, then my other choice is after tax. If I have after-tax options, that means I've already paid tax on the money today. It's most likely in my bank account, my checking account, my savings account, things like that. When you're here, now you can invest in things like real estate, right? You can go buy a property with the money in your checking account. You can go buy a business or start a business, again, with money that's already been taxed in your checking account. You can invest just in the regular stock market. So all of these will be taxed a little bit different. If you leave the money in there for 1 year plus 1 day, when you have capital gains, which is pretty nice. Capital gains normally is going to be about half of what your ordinary income tax is. So for most of you, you'll probably be in the 10 to 20% range. Right? So you're like, cool, that works. That works very nicely. I agree. So you can have your investments like that. And then you have your tax free. So for many of you, this will be municipal. Almost messed that up for a second there. The municipal bonds, those are city projects. So anytime you invest in the city, normally the state, your state will give you tax breaks on that. You've all heard of the Roth. Now, whether we talk about it as a backdoor Roth or mega Roth, all that stuff, it's still a Roth. It's still an investment that I put the money in, after tax money, and then it grows tax deferred and I can take it out tax free, right? Like it still is what it is. And the municipal bonds the same way, it's already been taxed. For many of you, you would consider investing in your HSA account. HSA account, triple tax benefit. We've talked about that regularly. The money goes in tax deferred, so you actually don't claim it as income. And then the money grows, or the money is tax deductible. You don't claim it as income. It grows tax deferred, so you don't pay tax on the growth each year. And then as long as you spend it on healthcare expenses, which all of us will have, then the money comes out tax free. Right, so these are normally going to be those. And then once you normally max out the other ones, you definitely can consider whole life. Right, whole life insurance as well. Another tax-free vehicle. It also can set up your estate where you have the liquidity, where you don't want your family, when the estate is, getting ready to go to court, things like that. You don't want them to have to sell something because they have to pay fees or taxes. So if you have something that's set up where they have liquid money available, such as a whole life policy, then that gives them the ability to pay off whatever those different fees are. So that way they could just make the most prudent financial decision with whatever those assets are. And whether that's paying off the old business partner, whether that's paying property tax, whether that's paying the estate court, whatever that looks like, just giving them a little bit of liquidity, that's tax-free money is a nice touch. It's like a nice little bow. It would just be a pleasant surprise for them. What we end up seeing is most people have almost all their money here, which means almost all your money is taxed as ordinary income, which I think we'll both agree that's probably not what we want. It would be nice to have the tax breaks of real estate and rental income. It would be nice to have the tax breaks of a business. There's still so many things that you can write off in your business, your travel, your food, and different things. And in the Tax Cuts Job Act of 2018, they removed a lot of those from personal deductions, but you still can deduct them from a business. And then we talked about the capital gains where there's much more favorable tax rate as well. That's nice. Then, of course, if you have the opportunity to have tax-free income, why not? It's your retirement. And so basically the big thing I'm trying to get you to realize is the question is, hey, if I have $1 million, am I able to have money for 30 years? Yes. If you have a plan that allows you to have money for 30 years, there are so many levers that you can pull, so many strategies that you can take. It's not always a straight up question where you just put the number in a calculator, $1 million, $40,000, how long will it last? It's where's my money allocated? How much am I paying in taxes? Do I have required minimum distributions? What's my lifestyle? There are many people, right? I'm in Florida. You all know I'm in Florida. There are a ton of people who move from New York to Florida because your pension from New York, you live like a sultan in Florida. We just have a lower cost of living. Before the cartels and everybody was being kidnapped and all that craziness, it was super common for people to retire on the northern of Mexico. It was very common to speak English. You had like a resort living lifestyle, but the cost was so low. People like to move to Italy, and I've seen people move to where's like Costa Rica, different places where if I have safety and my dollar is worth more there, then I'm able to maintain my lifestyle. So it really is when you're answering the question, it really is this idea that you can probably say yes in almost every situation. We just really have to be planning ahead of time. If you give yourself at least 5 years, it's so hard for me to imagine you not being able to put a plan in place for $1 million to work. And I showed you another video where even if you just as simple as where we leverage the money to get a higher return, where what you would do is you would say, you know what I'm going to do? I'm going to go buy a business. And if you could you imagine if you bought a business for $1 million, what that business would generate in monthly income? Because businesses don't have the same return that's required. So if I bought a business for $1 million, that means that business is probably, even if you did maybe a 2x of its general revenue, or you did a 3x multiple of its revenue, that means the business is literally generating hundreds of thousands of dollars every single year. So, right, it really is what you're comfortable with, how you envision your lifestyle, where you want to live at, and then we can put the plan in place. But it's very reasonable for you just to be able to put the plan in place to be able to say, I can just invest and take out the withdrawals. You can, like you totally can. All right. So on that, I mean, we are good. So let me go and see if we have any questions. Let's see here. All right. Hey, Ronald, how are you? It says, if there's other streams of income meeting my monthly liabilities, why would the amount of investments lasting 30 years be a paramount of concern? No, no, that's an excellent question. So, yeah, I know my naivete. No, none of that, Ronald, none of that. The reality is it's just a question. So that is how the question was asked to me. Hey, 30 years is kind of what people are saying. If I retire at 65 and 30 years of 95, I feel like that's all I need to know. Will my money last that long? And I'm with you that if you have your money invested in something that generates the income, then you're probably going to be fine. So if you have a pension and the pension pays you the rest of your life, then you're probably going to be okay. This question probably is for more people that have investments and they're not 100% sure about their investments. Or they're like, hey, what's going to happen with my investments? Can I keep up with inflation? Can I keep up with the up and the down of the stock market? And for me, the result is always yes, if we're planning ahead of time. Right. And so I think I had shown in my last video and then where we talk about the cycles that the economy goes through. So let me go through that really quickly and then we'll come back to it. All right. I think I had, yes, we'll add it to the stage. All right. So what we're basically saying here is every time the economy goes through, right, the same cycles, the same 4 cycles, just like seasons. So we have a time of expansion, but it can't grow forever, so it peaks. This is what we just went through during the last Biden administration, right after COVID. And so what ended up happening was everybody was sitting at home with a bunch of money. And gas was like $1 a gallon. People were just getting paid, hanging out. And as soon as we were all able to go out, what do? We started spending all the money. And everybody that was laid off got hired. Then everybody has a job. So how do I get you to leave your job to come to my place to work? Because everybody has money, so I have to fill this demand. Well, I have to offer you more than your last job. I have to make it a nice, sweet offer. So what do? I offer you like 20% more and a super new title, like VP of everything. And all of a sudden, everybody is getting 20% raises and they're getting these crazy titles. And then people go out and buy more cars, they buy new houses. You remember when people were paying $100,000 over asking price without blinking, paying $200,000 over asking price without blinking? So that's what happens. You go through expansion, but at some point it gets too good to be true. So then the government says, ooh, if we keep going and prices keep going up, it's going to get ugly. So what we do is we start raising interest rates. The Fed is like, no kibosh. So then we hit the peak. People are like, whoa, can't buy a house anymore. That's a little bit of house and a lot of expenses. People are like, whoa, I can't hire anymore. There's no more free money for business loans and things like that. So now I can't raise my prices. And so companies start laying people off. They're like, oh, I think I hired too many people. I thought it was going to keep going forever. I made that mistake. So we start laying people off. Well, what is that? We call that a recession. And that's roughly where we're at now, right? So people are being laid off. People are getting new jobs at lower rates. People aren't buying houses much anymore because rates are a little bit higher. And so we're teetering, whatever that looks like. And at some point you hit the trough. You got to hit the floor eventually. So there's debate what the floor will look like, but there's always a floor. And at some point, the Fed is going to do the opposite. They're going to start lowering interest rates. Well, if I then took a step back, that means that at this point in time, with higher interest rates, businesses are having struggles getting money, that the stock market, right, is probably going to go down. And at this point, with lower interest rate where money is free, the stock market is going to go up. And then what is that? You're right. That's expansion again. And so we go through those same cycles right, over and over and over again. So when people are asking me, hey, will my money last? Yeah, we're probably like around here. That's when I get those questions a lot. Hey, how many years will I be able to live off of my money? Right? Because I'm like, dude, every time I look at the stock market, it's going down. And I don't get those questions when we're over here. But that's the cycle. If we're here and you have a plan in place that's like, all right, as soon as the trough, I'm not telling you to be a fortune teller. What I'm saying is when you start seeing us here, you start seeing us go up, that you can start buying here and achieve a nice growth without being a fortune teller, without trying to like predict the market. You don't have to predict it when it's going to go up. You can just wait for it to actually go up, and then you can jump on then. And you don't have to try to predict when the floor is going to hit. Right? Warren Buffett loves to sell right around here, and then he waits, and you'll look him up. He has billions of dollars in cash, like $100 billion in cash. He's waiting to buy the stocks on sale. All right, so that question is almost always going to be people that don't have that income stream that's set up that way. And so they're not sure that their money's going to last. So that is definitely an excellent question. If your money's not tied to the market, then you're not worried about the market. If you have a pension or a reverse mortgage or an annuity or something like that, then you're just like, hey, look, my money's coming in, my money's coming in. So we're definitely good on that. Thank you. Excellent question. Remove that. All right, let's see here. Cool. All right, Rodney said comparisons are great. Appreciate that, my man. Appreciate that, Rodney, as always. That's all. Retired 2019. Said I made the mistake of retirement. What do you say? All right. So I made the mistake of retirement with pre-tax money and very little cash. Okay. I appreciate that. Retired in 2019. If I remember correctly, you said you retired in like, yeah, well, 2019. That's your name. I was gonna say, I remember you told me you retired like 5 years ago. So the fact that you retired for 5 years is still phenomenal. And it's not as much as I rarely use the word mistake. It's more like a lesson, right? We just learned something, and you're able to still make some changes, right? The windows isn't as large, so the changes, but we can still make changes and strategize and work through things. And I think you're doing a great job as far as the conversations that we had. I think you're doing a great job. Retired 2019. But a lot of us do that, and it's also important to know that there's just different tax rules. When like we will joke and say, hey, where's the worst place to leave your money for someone as far as an inheritance, and then like a pre-tax account, because depending on where it is, they have to take the money out in a certain amount of years. Then obviously it's all taxes, normal income, because you didn't pay taxes on it. His Uncle Sam was really mad that you lived your whole life without paying taxes on it, and so he just treats it differently. But when you have the money in something where you already paid taxes once, Uncle Sam just treats it a little bit better. He's just a very relaxed person. He's not hangry where he's worried about the tax revenue. And so even when you're talking about it from an estate perspective, it's normally a really good idea to if you can, to start moving the money from those pre-tax accounts, so that way you're able to give yourself a little bit of flexibility later on. Because Uncle Sam he's just not a nice person when he feels like he's been waiting for a very long time, which ironically, you and I would say, well, Uncle Sam, if you didn't have the 59.5 penalty, if I take the money out before then, I might have bought a business or real estate, but you made me leave it there. And he's like, I know, don't use my words against me. All right, then Ronald said, thanks. Hey, always. No, thank you. Thank you. Okay. All right, so on that note, if there are no more questions, and let's see, and I think we're pretty good. We went the hour, so we're good. The camera stayed. We didn't have any problems. So I think my mic is still on. Last time I was listening to the audio when it sounded so bad, and I found out that the mic wasn't on. So the mic is on today, so I'm feeling pretty good. If you have any questions, I'm telling you right now, any questions at all, I'm always here for you. You can shoot me a message at dre@citywiz.com. You can follow me on LinkedIn or the YouTube video or in anything like that. And we'll do this again next Thursday. As always, I'm thankful for our time together, and I appreciate you all so much. Hey, no problem. Retired 2019. Oh, what did I say? Says I recently started monthly CDs for storing cash. Is that practical? Oh, that's a good question. All right. So, is that practical? I don't know. Right. So, you're not allowed to ask a woman her age. I'm just messing. Generally speaking, if you want to keep the money in a CD, if you don't plan on touching that money for a year or two, then a CD is fine. If you don't plan on touching that money for like 5 years or over, normally that would be something where you want to give yourself the ability to grow in the market. If your plan is to put the money inside of the CD and you're sort of waiting for the trough of the recession and you're just going to kind of put some money on the side, kind of like Warren Buffett does, right? If you're following the news and the information kind of like that, then that's a very practical place. Most people would say, hey, look, I'm not 100% sure what we're going to do with these tariffs. It's like we have them, then we don't have them, we have them, then we don't have them. But it should be settled in a year or two. That's kind of what most people will feel, whatever that looks like. Whether you're actually going to do them and then we make the adjustments as an economy, or you don't do them and then people stop listening to you because you keep threatening to do them and even threatening like the boy who cried wolf for 2 years, so the market doesn't adjust anymore. So as far as if you want the money out of the market and just kind of be safe, then that would make sense. That will be very practical. We have to return then a savings account, which is like 0.0001%. And then normally a CD, the bank, I think it's probably going to be 1 to 2 years. I've seen them as high as 5. I probably wouldn't go much more than that, just generally speaking. Okay, 6 years, 6 years until retirement. What? That's so cool. Congratulations. Okay, so 6 years until retirement. If you're not going to touch it for 6 years, in my mind, right? Again, without knowing everything. So here, let me go back to the whiteboard. So I often show you guys that I do like the 3 bucket strategy. All right. And so you have your safe, right? You have your moderate, and you have your aggressive. Which means that if you always have a portion that is safe, so your CDs, your money market account, cash, you can have that. And even if you're retiring in 6 years, so then it becomes a question of what percentage of your investments are in the safe. And then you have your moderate. I messed that up. Okay, which is your income. And so this could be a balanced portfolio or a mutual fund. All right, so you have a balanced mutual fund. Probably wouldn't be anything more than that. You'd have your bonds here, and then you probably would have some sort of an annuity here as well. So that's gonna be your moderate. That's your income generating. Normally 3 to 5 years, normally 1 to 2 years, and then here we'll say everything's 8+. And my aggressive is going to be my stocks, my business, my real estate. Heck, you can have your precious metals. I mean, there are some people that are walking around doing like Bitcoin and things like that. As a side note, I would probably not do more than 5% ever on Bitcoin because in my mind, investing is determined by the value of something economically. And right now, Bitcoin and cryptocurrency don't have a strong economic value outside of the promise of its future use. When you're talking about retirement funds, generally speaking, that's a little bit too risky for most people's retirement funds. But if it's like your 5%, like almost like going golfing or going to the casino, and that's your gambling amount, everybody gets to use their money kind of gambling, right? Like, a small portion, right? Not your mortgage. So I say all that to say that if you're sitting here and you're like, hey, you know what, Dre? I have 50% here. I have 20 to 30% here. And then I have 20% here. Then this is fine. If you are saying 6 years out that you maybe are trying to get up to 50% here, it's a little bit riskier because I don't know how close you are as far as the amount that you need to maintain your lifestyle. but it would definitely be more of a question. So it really does depend on what the allocation is, how much you actually have as far as in those three buckets. But my general thought is you're totally fine, right? Not that big of a concern. Even if you were invested and you believed 100% in the stock market, you would still have a portion in cash and bonds and things like that. Like, still, you would still have a portion. So you wouldn't really be like, you wouldn't have none of it. And I showed you guys some of those allocations before, where, for example, here we go. Right. So you remember I showed you a few of these, what we call model portfolios. Very fancy way of saying that I'm going to be able to maintain a certain investment. And so, look, if I had a balanced portfolio, you can see that we would be 50%. You'd have 50% in bonds and 50% in growth. But even with that being said, you still have 10% in cash. Even if you had a balanced approach, if you had a moderate approach, we still have 6%. Again, this is just a model. It's not that it's a slam dunk, like you have to do it. I'm just simply showing that there's, in most allocations, we're still going to have something in cash. So I think you'll be fine with the amount that you have in CDs. It says other buckets recover about 5 to 7% for CDs. All right, it says no, sir. Other buckets are covered about 5 to 7%. Yeah, 5 to 7% for CDs. That's totally fine. Yeah, it's totally fine. All right, so that works out very good. Retired 2019. I appreciate your channel. I appreciate you all. No, that's no problem at all. That's no problem at all. I'm glad to help. Okay. All right, so I think that is it. Let me make sure that there's no more questions. I almost had missed it, Eagles chicken. I would, if I missed it, it would not have been on purpose. I just would have, I just didn't see it. Like, I'm not ducking you all. I love the questions. Okay. All right. So then on that note, I think we're good. I'll see you all again next Thursday. I hope you all have a fantastic rest of your week. Until next time, stay safe and enjoy life.